Hey, Mike here, and I'm still in the Bahamas visiting with Dave, and we've been talking together all day about what's going on in the stock market. At the end of January, we saw a record margin debt, and then we were looking at the figures this morning, and it's made a new record. It's still overvalued, but despite that, most people are extremely bullish on the market, and don't seem to be very concerned at all. In fact, someone a couple of days ago forwarded me an article saying that the Dow will go to 20,000. And if you doubt that, then you're going to miss out. What do you think about arguments like that?
I guess anything is possible. But really, and I started hounding you about this in the third and fourth quarter of last year, and it's funny is that, just a little backdrop to this, Mike tends to be the one who's a little more bearish than me, and I tend to be a little more even keel and that sort of thing. And it's worked both ways for both of us. But late last year, I started talking to Mike and saying, Mike, the market's crazy again. It's turning into another bubble. All these stupid social media stocks are going through the roof, and Yelp and Facebook and Twitter and whatever all have crazy valuations and all this sort of thing. So could the Dow go to 20,000 or the S&P 2,200 or something? Yeah, I guess anything is possible. But I really think that right now we're entering the precipice of another big market decline. And here's the numerous reasons why. Number one, the bubble's forming in certain sectors. Like I said, social media, biotech, 3D printing, these things, in my opinion, are all massive bubbles. They're all trading at huge multiples, 15, 20, 40 times revenues, not just times earnings. So I think this is very reminiscent of the 2000 bubble. You go look at the chart of the biotech indexes. They're all going straight parabolic up, just like they did in 2000. Number two is with them winding down liquidity. There's no top-line growth right now in most stocks. Even the big companies like McDonald's, etc., these big multinationals are just growing by increasing their margins. And margins, as a comparison to the size of the economy, are the highest they've ever been right now. So how much more cutting can they do? So we need real top-line growth. This is just being funded by cheap money. Like, if you can borrow at 1% instead of 7 or 8%, what's going to happen? You're going to be able to squeeze your margins by paying less interest. So that would be number two, that we don't have any really top-line growth. And number three is is sentiment. Investors' intelligence, the RIDEX ratio, and RIDEX is a group of funds, and it shows the amount of people that are in bullish funds compared to bearish funds. And the amount of bulls compared to bears is the lowest since the 2000 top. So sentiment is too one-sided. People are too bullish, and then the final key is valuation. The CAPE, or the 10-year trailing price-to-earnings ratio, is now over 25 in the S&P 500. Any other market last year that was over 24, and there were only a handful, on average lost between 15 and 20% of their value. Usually CAPEs, when they're that high, are as a sign that the market is very long-term overvalued, and performances over the next 5 to 10 years are very minimalistic. But you look at whenever the CAPE has gone over 25 historically, so the 10-year trailing price earnings ratio, the average 10-year return is about 2 to 3% on the markets. So for those four reasons, I'm very bearish right now. And obviously, if you want to throw in a small fifth, is that the Fed, with their tapering program, is going to do less liquidity. And at some point, like when they raised rates in 87, or they raised rates in 2006, 2007, that could really send stocks spiraling downwards. So, and right now it's a little ridiculous, but printing less money is a form of tightening now. But those are kind of the reasons why. So I'm really bearish on the stock market right now. I think we look at all these factors. It's overvalued. There's too much bullish sentiment. Oh, and the last reason I should point out is it's too long. The market is nearly 5 years old, the bull market. And actually, if it, say, hit a new high sometime in April, it would actually be the second longest bull market in the history of mankind, or the history of the U.S. markets. So it's old, it's overvalued, there's too much bullish sentiment, the Fed is somewhat tightening. So for all these reasons, I believe that we are nearing a major market top. And what we're going to talk about in the next video is that this is going to coincide with a bottom in gold and precious metals, which I think are making a major bottom, and these stocks are very undervalued. So, just I think I've pointed it out very well, is that the market right now is very overvalued, is sentiment's too frothy, the Fed is tightening, the bull market's old, and I think we, in 2014, can equal 2007 or 2000, where we make a very important top for the markets.